Welcome back to Intermediate Accounting. This video concludes Chapter 17, Accounting for Investments. In this video, we look at some other issues related to accounting for investments. Specifically, we look at the fair value option, and then the financial reporting of other comprehensive income, and accumulated other comprehensive income. So get your PowerPoint template ready, get some pen and some paper, and let's start taking some notes. Companies have the option to report most financial instruments at fair value, with those unrealized gains and losses being reported directly in net income. So what securities are we talking about that companies might want to choose this option for? The ones that aren't already at fair value with unrealized gains and losses through net income. So which instruments qualify there? We are talking about debt instruments, or debt investments classified as held to maturity, which are reported on the balance sheet at amortized cost. So therefore, there are no unrealized gains and losses. And debt investments that are reported as available for sale, which means they are reported on the balance sheet at fair value, but those unrealized holding gains and losses don't go through OCI. What other financial instrument do we talk about that is not a debt investment, where we do not see them reported at fair value with unrealized gains and losses going through income? Equity investments reported classified using the equity method. Remember, the equity method is used if the investor holds greater than about 20%, but less than or equal to 50% of the investee's common stock. Now, if a company does choose to use the fair value option on a security, it is applied on an instrument by instrument basis. And is generally available only at the time that the company first purchases that instrument. Once a company does decide to use the fair value option on a specific financial instrument, that company must measure this instrument at fair value until it no longer has ownership. So until the instrument matures, if it's a debt instrument, or until they sell it. Let's take a look at an example. Hardy Company purchases bonds in Fielder Company during 2020 that it classifies as available for sale. At December 31st, 2020, the cost of the security is $100,000. Its fair value at the end of the year is $125,000. If Hardy chooses the fair value option to account for the Fielder Company's stock, it makes the following entry at December 31st, 2020. Obviously, this should not be saying stock, this should be saying the Fielder Company bonds. So if we're using the fair value option, we are going to record the debt investments. We're going to increase the value of the debt investments by the $25,000 unrealized holding gain. And of course, we're going to record this to unrealized holding gain or loss dash income, because that's what we're doing with the fair value option, going directly into net income. Next, let's look at the financial accounting and reporting for other comprehensive income, and accumulated other comprehensive income. Remember in Intermediate 1, when we looked at the income statement in detail, we said that comprehensive income could be reported in one of two ways that are allowed by GAAP. Right immediately below net income on the income statement, the company can then adjust from net income to comprehensive income. But most companies are choosing the second method. They have the income statement on one page, and then on a separate page, they have a separate statement of comprehensive income. It starts with net income, then shows the major components of other comprehensive income, and at the bottom reports total comprehensive income. Let's take a look at an example. On January 1st, 2020, Hinge's company had cash and common stock of $50,000. At that date, the company had nothing else. On January 2nd, the next day, the company purchases for cash $50,000 of debt securities classified as available for sale. On June 30th, the company sold part of the available for sale debt security portfolio. Investments that had cost $20,000 were sold for $22,000. The company did not purchase or sell any other securities, so it held the others securities that had a cost of $30,000. It received $3,000 of interest during the year. On December 31st, year end, the portfolio had a fair value of $34,000. We are asked to calculate net income, other comprehensive income, and accumulated other comprehensive income. And as we do each one, let's show how that would be reported on the financial statements. Start by taking a look at what we know here. We see the first thing is that the investments that had cost $20,000 were sold for $22,000. That increase in price above cost upon sale, this difference of $2,000, is what we would refer to as a realized gain. And realized gains always go directly to net income. The company received $3,000 in interest. Interest is always reported in net income. And on 12/31/2020, the portfolio had a fair value of $34,000. So we had securities that had cost $30,000, right? Because we had the initial $50,000 investment. And then we sold $20,000 worth of securities. So we have $30,000 worth of cost of securities that increased to $34,000. So this increase in fair value of $4,000 is what we would call an unrealized gain. And we don't see anything about the fair value option being used. We know that these debt securities are classified as available for sale. So where does this unrealized gain get reported? Is it net income or other comprehensive income? Available for sale securities changes in fair values. Unrealized gains are reported in other comprehensive income. Let's take a look one at a time. First, let's start with the income statement. We are going to have, for the income statement, we're going to report interest revenue, of $3,000, and the realized gain or gain on sale for $2,000. So based on our information, net income would be $5,000. How about comprehensive income? Remember, comprehensive income always starts with net income directly from that last subtotal on the income statement. And then we add any other comprehensive income or subtract an other comprehensive loss. Now there are other components of other comprehensive income, but in this course we've only discussed one thing, these unrealized holding gains and losses on available for sale debt investments. This was a $4,000 unrealized gain, so total comprehensive income would be $9,000. Next, what happens to this $4,000 sitting in other comprehensive income? We're going to report that on the statement of stockholders' equity. We may have discussed this briefly in Intermediate 1, but the statement of stockholders' equity shows what it says, how has stockholders' equity changed during the period? And stockholders' equity is not simply just common stock and retained earnings, but it's also this other accumulated other comprehensive income balance. So we have our beginning balance of in common stock of 50,000. To that, we're going to add net income, because net income increases retained earnings. This is just our total of these three fields. And then we're also going to add other comprehensive income. We would subtract if there was other comprehensive loss. And our other comprehensive income, as we saw here, was $4,000. We started off with a zero balance in AOCI, now we're increasing it by 4,000. And we would report also the ending balances in each one of these fields. So we still have common stock of 50,000. We have retained earnings of 5,000, accumulated other comprehensive income of 4,000, and that gives us total equity of 59,000 at the end of the period. How would accumulated other comprehensive income be reported on the balance sheet? Well, in the stockholders' equity section, we have our common stock, our retained earnings, and we're going to add that accumulated other comprehensive income account. Started off with a zero beginning balance, and then we just added to the balance the OCI for this period of 4,000. Now let's say the beginning balance had been 10,000. Our ending balance on December 31st, 2020 would of course be 14,000 in that case. This concludes our discussion of other items that we want to know related to accounting for investments.